Well, those in Florida are bracing for what is expected to be a Category 5 hurricane, Hurricane Milton, barreling towards the Gulf Coast with the eye expected to be around Tampa. Of course, this comes just 2 weeks after Hurricane Helene devastated the region. Hurricane Milton is expected to be even more catastrophic. Evacuation orders are in effect. And business and shelves are emptying. You can see here that these facilities are being set up for people who are forced to leave their homes. And what will be a very harrowing 48 hours for those in that area of Florida. Our hearts go out to those people for sure. Investors and analysts, though, already sharpening their pencils and taking a look at where this could show up in the market. For the insurance sector, for example, RBC estimating that this is going to lead to as much as $60 billion in damages. There will have to be a huge rebuild effort. In fact, shares of Home Depot and Lowe's closed at record highs. Let's bring in Clark Geranen, who's the chief market strategist at Calbay Investments. Clark, thanks so much for joining us. I guess this is what investors do. We got to get down to the business of finding out how this is going to disrupt business or enhance it in certain cases, even as we know there's so much suffering that's going on.
Sure. Thank you for having me. And I would like to say that we are looking very closely over the next 48 hours as hurricanes approach Florida. And what we see is, like you said, home builder stocks ended at record highs over the past few days. And they had been hurt right when interest rates had dropped, but they weathered the storm over the past few years. And we really think that this could be a tailwind for them moving forward, with obviously multiple homes needing to be built. So this is going to provide an increase on employment for jobs, but we could see it turn into inflationary measures. So because prices could go up, this could have a lagging effect on the home builders.
That's an interesting perspective, yes, because, and you'd imagine too that if their stores are closed, that doesn't really help the rebuild effort. Generally, how are you approaching a Home Depot and Lowe's? Because this is the hurricane to contend with, but as you mentioned, there's also the big picture. Would you be comfortable adding here?
Sure. So we've been looking at home builders over the past year, and we do still think that they will continue to do well. And mainly that's just because a lowerage in the interest rates. And so we think that mortgage rates coming down is going to help home builders in general. They've weathered the storm so well, and we think they'll continue to do so.
I've also seen some commentary on Disney, for example, in Orlando, not expected to be devastated as much as, say, the Tampa area, but some estimates saying they're going to face damage maybe upwards of $200 million and obviously see a drop in attendance at the parks. And Clark, this is coming at a time where there's already concern about the parks in general.
While I can't speak to any specific stock, I will say that we feel strongly about the consumer. So consumer discretionary spending, we like to say, don't fight consumer spending, especially when it makes up 70% of our GDP. And as we've seen with higher wages, lower interest rates, and historically low unemployment numbers, we don't want to fight the consumer. So that could add to discretionary spending as far as going on trips, amusement parks, et cetera. So that definitely is a sector that we like over the next 12 months.
We are going to be hearing, well, not really hearing, but we're going to get the Federal Reserve minutes from the interest rate decision made in September when we got that larger than expected 50 basis point rate cut. What are you expecting, or what are you looking to glean from those minutes, if anything?
So in the report tomorrow, we're looking for inflation to come down to 2.3 from 2.5. So we are inching towards that 2% target that the Fed has set. We also think that core CPI is still going to be hanging up a little bit higher, around 3.2. And that's mainly due to the higher services inflation, which is closely tied to wage inflation. So since wages have continued to stay high, we see that those are going to need to come down in order for that core CPI number to track downward like the traditional CPI.
Okay, Clark, thanks so much for joining us with this insight. That's Clark Geranen, who is a chief market strategist at Cal Bay.